Listen up. Forget everything you know about investing because the market just went full carnival again. We are talking about Beyond Meat, the fake burger company. This stock just went absolutely bonkers. It exploded by 146% in a single day. 146%. That means if you went all in on Monday, you literally more than doubled your money by Tuesday's closing bell. But that's just the tip of the crazy iceberg. This massive jump capped off a 3-day run where the stock soared by more than 600%. 600%. That's enough to make your head spin. Just last week, this company was trading like trash. It crashed down to 50 cents a share, 50 measly pennies. It was sitting in the gutter, practically begging for bankruptcy. Then suddenly, boom, it rocketed up to about $3.60. We saw this movie before. It's the ultimate Wall Street grudge match. Retail investors, that's you, me, and everyone hanging out on the internet, versus the big hedge funds betting against the stock. It's a classic short squeeze, and it is glorious chaos. Here's the deal. The biggest reason Beyond Meat blew up is simple. It was massively shorted. These short sellers, the guys who bet that the stock price would fall, were everywhere. Over 60% of every tradable share was sold short. Think about that. Most people holding this stock were actually praying for it to fail. When a stock is that heavily shorted, it is a ticking time bomb. All it takes is a spark. And we got 2 huge sparks this week. Spark number 1, Beyond Meat got added to a special investment fund, the meme stock fund. Yeah, that's a real thing. It's a basket of stocks known for getting wild thanks to online buzz. The moment that fund announced they were adding Beyond Meat, the retail army saw their target. The second spark was real business news. Beyond Meat announced they are expanding their partnership with Walmart. Walmart, the biggest retailer in the whole country. This is huge. The company is sending their plant-based products to over 2,000 Walmart stores nationwide. That's a massive distribution jump. Now, when a stock with 60% of its shares bet against gets good news, those short sellers get absolutely hammered. They panic. They have to buy back shares immediately to stop losing infinite money. When they rush to buy, it drives the price higher, which forces more of them to buy. It's a feeding frenzy. That is the short squeeze. And let me tell you, that squeeze was extra crispy this week. But you have to ignore the noise for a minute. You need to look past the rocket emojis and the massive percentage gains because the actual business running Beyond Meat, it is still struggling hard. For 5 straight years, this company has lost money. Think about that for a second. 5 years straight. They are facing big problems. Their revenue is falling, their operating costs are rising, and people aren't buying fake meat like they used to. The company went public back in 2019, and the stock traded for about $240 a share. It was Wall Street royalty. Now, it's been one long slide into the penny stock basement. And just before this rally kicked off, the company was in a seriously tight spot. Last week, they had to restructure their debt. This is some insider financial stuff, but here's the bottom line. They traded old debt for new debt, and crucially, they issued a ton of new stock. This deal was necessary to try and dodge immediate bankruptcy. They got rid of about $1 billion in old IOUs. That sounds good, right? The downside, they printed up hundreds of millions of new shares. This is called dilution. It means if you owned 1% of the company before, you own way less now. This diluted the value for every current shareholder. Normally, that sends a stock crashing. And it did crash, dropping to 50 cents briefly. But the retail crowd saw that debt restructuring deal differently. One specific trader, a guy who goes by Capybara Stocks online, said everyone was misunderstanding the situation. He bought about 4% of the entire company stock while it was dirt cheap. 4%. He said that by swapping debt, they made the company's balance sheet stronger. They survived the immediate death threat. And he was right. That aggressive play, combined with the massive short interest, created the perfect setup for this monster surge. This whole battle has serious echoes of the GameStop madness from a few years ago. Retail investors found a highly bet against stock, rallied online, and squeezed the institutions. Now, Beyond Meat is the new battleground. But let's talk about the business again, because that's what matters long term. Is there any hope here, or is this just a quick pump and dump? The new Walmart deal is important because it hits the right market. Beyond Meat is increasing distribution across over 2,000 stores, and they're rolling out a new product that is designed to bring in new customers, the Beyond Burger 6-pack. Why a 6-pack? Because it's a value pack. At a time when everyone is watching food prices skyrocket, Beyond Meat is trying to offer a cheaper option. They are trying to reach regular shoppers, not just specialty buyers. They're emphasizing the health pitch, too. This new burger pack gives you 21 grams of protein per serving. 21 grams! Plus, zero cholesterol. And only 2 grams of saturated fat, thanks to avocado oil. They're also pushing other products nationally, like Beyond Chicken Pieces and a Korean barbecue-style Beyond Steak. The chicken pieces have 21 grams of protein with almost no saturated fat, just about half a gram. The steak tips boast 20 grams of protein. They are trying to simplify the health pitch: high protein, no cholesterol, low bad fat. This whole expansion is a bold move to get their product in front of way more American consumers. But the company's financial metrics are still flashing red. We're talking about massive operational weaknesses. The costs to make their products are just too high. They spend way more than they bring in. They have nearly $1.2 billion in long-term debt hanging over them, which is more than their total assets. That is a massive rain cloud, people. The dilution from the debt swap is also a huge problem. Even if they somehow start making a profit tomorrow, that profit is now divided up among 4 times as many shares. It makes it tough to deliver big returns to investors over the long haul. So here is the million-dollar question. Can Beyond Meat use this insane meme stock momentum to save itself? GameStop did it. GameStop used its artificially high stock price to sell hundreds of millions of new shares to the public. They raised a ton of cash. That money transformed their balance sheet and gave them a huge cash cushion. Beyond Meat is sitting here right now with its stock price artificially inflated by internet buzz and short seller fear. If they play their cards right, they could try to sell more stock to raise cash and fix their core business problems. But if they fail to capitalize on this rally, or if the overall plant-based market continues to cool off, this stock is going to crash hard. Analysts on Wall Street are cautious. They have given the stock sell ratings, not buy ratings. Their price targets are often way below where the stock is trading right now. They look at the actual company performance, the fact that revenue's falling and they are losing cash every quarter, and they say, stay away. But the retail traders, they're talking about the stock hitting $6 a share next. That is another massive jump from here. It is pure speculation. They are betting on fear and momentum, not on the numbers. This is a high-stakes gamble. The stock is going to remain wild. It will swing up and down faster than a kid on a trampoline. We are watching a volatile moment in the market where the reality of the business has nothing to do with the price of the stock. It's all driven by sentiment and the pain of the short sellers. The company has a big test coming up. They report earnings soon. That report is going to be the moment Wall Street gets a fresh look at the true state of their sales and their spending. That will be a critical point that could change everything. For now, Beyond Meat is the hottest stock on the block. It's volatile, risky, and highly entertaining. This latest surge is proof that the retail investor army is back, and they are not done fighting the big institutional players. Stay smart, stay safe, and remember that wild gains come with wild risks. All right, that's the story. If you want more videos breaking down the market chaos, smash that like button, hit subscribe, and ring the bell so you don't miss a thing. I'll catch you next time.